Hi class, let's go over chapter 5. Remember this graph? This represents the accounting cycle. In the previous chapters, we learned about step 1 to 7. In this chapter, we're going to look at step 8 and step 9. After company prepare adjusted trial balance and financial statement, the companies will need to do closing entries. And then after all the closing entries are recorded, companies need to prepare post-closing trial balance. Closing entries prepare a company for the next accounting period by clearing any outstanding balances in the temporary accounts. The post-closing trial balances ensure that all debits equal to all credits. It also double checks that only accounts with balances are permanent accounts. So we have temporary and permanent accounts. We're gonna look at these two types of account later in the chapter. So let's look at closing entries. Closing entries prepare a company of the next accounting period by clearing any outstanding balances in certain accounts that should not transfer over to the next period. Closing means returning account to zero balances. We do not return our account to zero balances. We only return temporary account to zero balances. Company need to close their book at the end of the fiscal year so they can prepare any annual financial statements and tax returns. Revenue, expense, and dividends are closed at the end of a year. So revenue, expense, and dividends are close to zero balance at the end of the year and begin with zero at the start of the next accounting period. For example, you own a business on December 31st, 2020. For the year of 2020, your business had $100,000 revenue and incurred $30,000 expenses. So on January 1st, 2021, how is your company financial looks like for 2021 before you open the business? Do you have any revenue expenses? No, right? You have not started the year 2021 yet. So the current balance for revenue expenses are zero on January 1st. These accounts were closed to zero on December 31st last year. And what about assets and liabilities? How much asset do you own? How much liability do you have? How much cash do you have in the bank on January 1st? What is the value of the land you own, equipment you own, and how much money you owe? These accounts do not have zero balances at the beginning of 2021, right? So these accounts are not closed on December 31st last year. Balances are carried forward. So at the end of the year, revenue, expenses, and dividend are set back to zero. Assets and liabilities will remain in the balances. Stockholder equity account will also remain in their balances. Permanent and temporary accounts. As we talked about earlier, for permanent accounts are accounts that transfer balances to the next period. These are not closed. These balances are not returned to zero at the end of the fiscal year. So these are balance sheet account, asset, liability, stockholder equities account. These accounts are not part of the closing entries. Permanent accounts. These accounts are closed at the end of each accounting period. These are income statement account, dividends, and income summary account. Temporary account keep their balances during the current accounting period and are set back to zero when the period ends. Revenue expense are close to income summary. Income summary and dividends then close to return earning account. The return earning account is a temporary, return earning account is a permanent account. So what is income summary account? We have not seen this account in the previous chapters. Income summary account is an intermediary between revenue, expenses, and return earning accounts. It stores all the closing information for revenue expenses. Income summary is a non-defined account. It have zero balances throughout the entire year until the closing entry are prepared. So throughout the year, when we record transactions, we do not use this income summary account. We only use income summary account when we prepare closing entries. So this income summary account does not appear on any trial balances or financial statements. So let's look at what are permanent, what are temporary accounts. Income statement account, revenue expenses, and dividend account. These three accounts are temporary accounts. Balance sheet account, asset, contract asset, liability, stockholder equity account. These are permanent accounts. So just remember, all balance sheet accounts are permanent accounts. Income statement accounts and dividend accounts are permanent. These are temporary accounts. Let's look at some examples. Let's identify whether these accounts are temporary or permanent. Rent expense. Rent expense is income summary account. It's an expense account. These need to be closed at the end of a year. So this is a temporary account. Unearned revenue. Unearned revenue is a liability account. That's on balance sheet. This is a permanent account. Accumulate depreciation. This is a contract asset account. It's also a balance sheet account. So it's a permanent account. Common stock is a permanent account. Fees revenue, that's an income statement account, revenue account. This is a temporary account. Dividends, as we'll talk about, this is a temporary account. Prepaid insurance is an asset account. It's a balance sheet account. So this is a permanent account. Account payable is a liability. It belongs to balance sheet. So this is a permanent account. So step A in the accounting cycle is to prepare closing entries, which includes journalizing and posting the entry to the ledger. So therefore, four entries occur during the closing process. First, close revenue account to income summary account. Second, close expense account to summary account to income summary account. So step 1 and step 2, close revenue account and expense account to income summary account. Third step, close income summary account to return earnings. The last step, close dividend account to return earnings. So let's look at these steps one by one. Step 1, close all revenue account to income summary account. So at the end of the accounting period, we had interest revenue and service revenue of credit balances of $140 and $10,100. So in order to close these two accounts, return these two accounts to zero balance, we need debit entry. So we had debit of interest revenue of $140 and debit service revenue of $10,100. So the offset entry is to credit income summary of $10,240. So that's step 1. Close all revenue accounts, debit all your revenue accounts to income summary accounts. So in the T account form, throughout the month, we have several service revenues. So at the end of January, our service revenue have a credit balance of $10,100. We need to close this revenue account. So we have a debit entry of $10,100. After this, our service revenue have a zero balance. For interest revenue, the same thing. At the end of January, the interest revenue had a credit balance of 140. In order to close that, in order to return this account to zero, we need a debit entry of 140. So now we have debit 140 and then we have a credit 140. Now our account balance is zero. Since we debit interest revenue on 140 and debit service revenue on 140, we need credit. So those we need to credit to income summary account. So now our income summary account have $10,240. So that's this closing entry post to T account. So after that, our revenue accounts all have zero balances. Our income summary account have a balance. Step 2, close our expense account to income summary account. At the end of January, we have several expense account balance. Supply expense of 100, depreciation expense of 75, salary expense, and utility expense. These accounts had original balance of debit. In order to close this account, return this account to zero, we need to credit this account. So we credit this account by these account balances. The offset entries income summary, debit income summary of the total of the expense account balance. So posting that to T account. Supply account, we originally had, at the end of the period, we had debit balance of 100. So we credit supply expense of 100. Now our supply account have zero balances. Depreciation expense, the same thing. We had balance of 75. Then we credit 75. Now our depreciation expense account have zero balances. Salary expense, we had balance of debit of $5,100. Our closing entry is to credit salary expense of $5,100. Now our salary expense have zero balance. Utility expense had balance of $300. We did a credit entry of $300 to utility expense. Now our utility expense have zero balances. We zero all the expense account. Those will go to close to income summary account. So we had income summary account debit of 5575, which is this, right? So all your credit, you credit all your expense account, the total of 5575, that's a debit to income summary account. That's our income summary entry. Remember, this one was to close revenue. Here is to close, on the left, debit is to close expense. So after the first two closing entry, our income summary have credit balance of $4,665. So look at here. Your income summary balance equal to your net income. Well, if you have net loss, your income summary balance will equal to net loss. Step 3 is to close income summary account to return earning account. Our income summary account here had credit balance of 4665. Now we need to close that. So we need the debit of income summary of 4665. So that income summary need to close to return earning. So we debit income summary of 4665, we credit return earning of 4665. Posting that to T account, we had these two entries to close revenue expense. And we have debit to income summary account, right? Debit income summary 4665. Now our income summary have account balance of 0. Income summary becomes 0. because we debited income summary, close income summary to 0, we needed to credit return earning for the same amount. Now our return earning have credit balance of 4665. So we closed, after step 3, we closed expense account, we closed revenue account, we also closed income summary account. So all these accounts have 0 balances now. Everything is in the return earning account. Step 4, close dividend account to return earning. Our dividend account at the end of the period have debit of $100. In order to close that, we need to credit dividend by 100. We credit dividend by 100. We need to debit return earning by 100. Posting that to T account, dividend, we had $100 debit balance. Our closing entry, we did a credit of dividend $100. Now our dividend have 0 balance. We credit dividend of 100, so we debited return earning for 100. Now our returning have balances of 4565. This is the previous entry. 4665 was the entry to close income summary, remember? And then we add in another one, debit 100. So now we have a new balance for return earning. So after we do those, let's look at the statement of return earning. These closing entries are necessary to actually move the income and dividend to return earning accounts. Right? We close revenue expense to income statement, then we close income statement to return earning. We also close the dividend to return earning. So let's look at this statement of return earning. This comes here. That's your income, right? And then our dividend go here. Now our ending balance for 4565 is our return earning balance of 4565. So after we did the closing entries, this is a T account. These are T accounts for all the accounts we have. Cash, account receivable, interest receivable, supply equipment, accumulated depreciation. These are asset accounts. We did not do any entry to the asset account during the closing entry. So these accounts still had their balances, no change. Account payable, salary payable, unearned income, these are liability accounts. These had no change neither. So all the revenue, expense, and dividend account, we did the closing entry. Now all these accounts have 0 balances, right? So after you do the closing entries, all your permanent account balances remain. It's the same as before. All your temporary account, the revenue account, expense account, and dividend account, all have 0 balances after closing entries. So after we do the closing entries, we will prepare post-closing entry trial balance. So post means after. Let's look at the trial balance. This is the trial balance after you do your closing entry. So you can see all debit equal to all credit. But the only accounts left here are permanent accounts. We have cash, account receivable, interest receivable, these supplies, equipment, accumulated depreciation, these are asset accounts, have balances. Accounts payable, salary payable, unearned income, liabilities all have balances. Common stock return earning have balances. So these are all permanent accounts. You do not see revenue, expense, and dividend accounts anymore. Those accounts are close to 0. So this is how post-closing trial balance looks like.